What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this video is a brief Ortex and options chain update. We have something very interesting in particular to talk about in regards to Ortex, and I want to make sure you guys fully understand exactly what these different sections mean so we can basically figure out what could potentially be happening with AMC and the short interest at the current time. The second thing is we're going to be going over the institutional ownership change over the last quarter for AMC. When we see increases in institutional ownership position, especially when we have already seen the stock go from the $8 to $14 range all the way up to the $70 range and is now back down in this $37 to $40 range, it is a great sign that institutions are continuously buying this stock. Now, typically, when we see institutions start to buy, they buy based off of fundamentals. So when we're seeing them buy AMC above what are technically its fundamental valuation levels right now, they obviously believe in the short squeeze situation that we have going forward. It's a great sign, and I can't wait to share all of that with you guys. So what we also have to go over is we've been talking about the overall market conditions on this channel a lot and how they apply to AMC. There is something very interesting that I want to bring up again today. It's a new article with a lot of different economic indicators that suggest we are headed towards a major market event, and it has really been caused by the actions that the Fed has taken. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And the more people that we have staying up to date with accurate AMC information, the stronger our community becomes. Now, when we're looking at the chart of AMC today, we are down about 5.8, 5.9%. This is not something that we would want to see, but what I would suggest to you guys is try to keep your emotions in check. When we actually get into the squeeze, we are going to see these wild price fluctuations, and you need to be able to keep your emotions in check. You're really going to think that these price movements that we have been seeing over the last month are nothing compared to what we could potentially see in the coming future. Now, coming over to Ortex, the key thing that I want to talk about here is the utilization. So in general, the utilization is the amount of shares that institutions are willing to lend out versus the amount of shares that have been lent out already. The fact that utilization is steadily climbing again, meaning this is essentially meaning that shares are getting loaned out at a higher rate than they were before. So if utilization can continuously go up, we're going to see AMC become harder and harder to borrow. Now, what does this do? It increases the borrow fee rates. It basically tightens the locate requirements on a lot of these institutions who are lending out shares, because if they can't find shares and they have clients that want to short the stock, they would almost have to just go out and naked short, which is illegal unless you are a market maker where they can actually do a version of naked shorting. Now, moving over to take a look at the option chain, when we come over to Stonko Tracker, 16,000 calls in the money for this week with 209,000 out of the money. On the put side, we have about 24,000 puts in the money and 78,000 puts out of the money. Now, we know that a lot of these out of the money contracts are heavily concentrated at these higher strike prices. So in order to see a lot more volatility or aggressive price movements in AMC, we would already need to see a significant move to the upside or downside in order to cause these institutions to have to go out on the open market to buy shares or short shares in order to cover or hedge the calls or puts that they have sold. Now, when we come over to the screenshot right here, this is a screenshot from First Trade. So essentially what's going on here is they are saying, error, this symbol cannot be shorted. We've seen this happen in the past with a couple of different stocks where the margin requirements or the different brokerages see that there is too much risk in shorting a given security, so they just turn off that ability. We've seen it at Charles Schwab with their margin requirements, and we've also seen it at prime brokerage operations in the past, actually in May, at Goldman Sachs, Citigroup, Jefferies, and a couple of other institutions. So what this mainly tells us, the fact that AMC is no longer able to be shorted at a couple of these institutions, it essentially just means that they find it's too risky to allow their clients to enter into a short position on one of these stocks. Now, this does not mean that hedge funds cannot actually get shares to short. This is more geared towards retail, but those prime brokerage operations short restrictions, yes, then those may apply to hedge funds. So when we come over to FinTel, When we look over here, this is going to track all of the institutional buys and sells over the last quarter. When we scroll all the way up to the top here, we can see that BlackRock Advantage Small Cap Core Fund institutional shares, I don't know why they don't just make those names shorter, but 448,000 shares over the last quarter. This is a pretty significant amount of BlackRock to buy. They already have a significant position in AMC, and it's a really good sign to see them continuously adding to it, especially after the stock has continuously gone up. What it means is that even though the stock has already gone up a wild amount over the last quarter, they still see a lot of upside in this given investment, which just benefits us as retail investors as well. Scrolling down a little bit further, we can see that Fidelity Series Total Market Index Fund added about has a position of 344,000 shares and increased their position size by 253%. Again, we have big institutions coming in, scooping up a lot of shares of AMC, and the fact that we've already seen it gone up, I'm going to keep saying this because this is really the important part that you need to understand, that when the stock goes up so much, you would typically expect to see a lot of institutional selling. That is not what we are really seeing on these 13F filings. Now, let's continue this conversation that we've been having about the broad market. When we come over to another article by Zero Hedge, bullish speculation is evident in the overall market. Now, Minsky is an economist, so Minsky specifically noted that during periods of bullish speculation, if they last long enough, the excesses generated by reckless speculative activity will eventually lead to a crisis. Of course, the longer the speculation occurs, the more severe the problem will be. Currently, we see clear evidence of bullish speculation due to commission-free trading on mobile apps. Retail trading has exploded. We know this is going on. A surge in IPOs, a record increase in SPACs, investors paying record multiples and prices for money-losing companies. Option contract speculation has seen record increases. Margin debt at new highs and near record annual increases. That is one of the key points that I want you guys to keep in the back of your head. The key word there is over-leveraging. If anything starts to happen with the broad market, they're going to get margin called more than they are already getting margin called right now on their over leveraged short positions. So we also know that a new NSCC rule could potentially come into effect in the near future. But if that rule is not put into effect before we see this major market event, that rule is not going to help out with that controlled market crash. Again, not a controlled squeeze, but the controlled market crash. That rule is not really going to be able to help out anybody if it is not implemented and effective before the actual major market event. Now, when we scroll down a little bit further, we can see a very interesting phenomenon happening with corporate bond yields. These are going to be the CCC rated bonds. These are corporate bonds just one notch above default and should carry very high yields to compensate for that default risk. When you're thinking about the bond market or the fixed income market as a whole, when you think of high yield, you need to think of very risky. So these bonds are typically very risky because they are one level above default. So you would expect to see these yields be very, very high. That's not what we're seeing as reflected in this chart. We're actually seeing these types of yields at an all-time low. Now, when we scroll down a little bit further, the Fed is dependent on everyone acting rationally. When we think about the AMC and GameStop short squeeze situation, retail is not acting in the way that they typically would act when they're all putting money into an investment, whatever that may be. When the stock goes up a significant amount, you would expect a lot of people to take profits, but that's not what's going on in this situation. We see the stock run up, people continuously buy, it falls more, they buy even more. Now, unfortunately, that has never been the case. Throughout history, as noted above, the Fed's actions have repeatedly led to adverse outcomes despite the best of intentions. We have seen the Fed come out time and time again and say, hey, everything is fine, inflation's transitory, we're expecting it to be in this range, but essentially every single time the inflation numbers come out, they're always higher than expected, and the Fed acts really surprised. But what you cannot debate is the fact that the margin debt in the United States at the current time is at its essentially all-time high at $900 billion, and we are seeing, as reflected right here, the 10-year Treasury yield continuously decreasing, meaning that a lot of money is flowing out of equities and into bonds. We have already seen Goldman Sachs liquidate. Goldman Sachs liquidated 25% of all of their equity investments. We've seen Morgan Stanley calling for a 20% drop in the overall market by the end of the year. We've seen credit Credit Suisse come out and says that they're transferring a lot of their investments into gold, which is essentially an inflationary investment. They are trying to protect themselves against inflation. There is a lot of evidence that a major market event is coming, and AMC and GameStop could potentially be the best hedge out on the market at the current time. So that is going to conclude this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day, and I'll see you guys in the next video.